All right, well, joining me now with more on the markets, the jobs picture, trade, and yes, this bill making its way through the House is Jay Woods. He's a chief market strategist at Freedom Capital Markets. Jay, always a pleasure.
Always, yes. How are you?
I'm good, thank you. So action little changed in the equity markets this morning and yesterday, but right near record highs. How does the market look?
Well, let's start with that ADP number that came out. We had a decrease when we were expecting 100,000 added versus a loss of 33,000. So that is usually eye-opening. The ADP can sometimes move markets. It hasn't really, hurt the futures yet, but we'll focus tomorrow on that unemployment number as well as the jobless claims. So, for people wondering why that didn't have a deeper impact on the market, it's ADP's wonky.
Since COVID, I think the ADP report hasn't necessarily been as spot on as we had seen it in the past.
Well, let's just put it this way. When you look at analyst expectations for it, they're never right. It's all over the map. And I don't want to, the analysts do a good job, but not when it comes to ADP payroll estimates. They've been off, and the key is, though, it was a decrease, and that should be eye-opening. But being the holiday weekend, being the beginning of the second half, I think we're focused on other things right now.
Okay, so let's talk about the jobs report right out tomorrow. Still 110,000 jobs estimated were added in June, despite this disappointing ADP private payrolls data. What does that mean for the Fed, which we know could impact markets? Yeah,
well, it's about the trends. I'm a trend follower when it comes to stocks, but also when it comes to economic data. And we're starting to see things trend where there was a decrease in the ADP. We're not adding as many jobs as we usually do. The trend in the 4-week moving average on jobless claims, which also comes out tomorrow, is getting closer to 240,000. 250,000 is a number where we pause. Now, what does this mean for the Fed? Well, if those jobless claims continue to rise, if unemployment rises, which it's expected 4.2, now 4.3 next month, that gives them reason to cut rates. That was the one reason they gave, the dual mandate, inflation under control, but jobs starting to, not be as abundant as they once were. So if we see a number tick up, then there's more reason for the Fed to cut rates, especially if we haven't seen the inflationary numbers go up. So it's going to be the narrative. It already is if you follow Truth Social and the president's rantings on social media to get the Fed to lower rates. This will be just another reason that course will grow louder as we get to the end of July.
Right. So you referenced there, obviously the Fed's next meeting is at the end of July. Stocks right near record highs. The first half of the year categorized by quite a bit of volatility. What do you anticipate for the second half?
Well, I don't think we're going to be as volatile as the first half. I think we got through it. That temper, what would we call it? The Liberation Day chart that scared us to death, and down 15% in 3 days on an intraday basis. On that third day, we did reverse. I think the worst is behind us, and now we have to look for leadership. And where's that leadership going to be? Well, industrials were the number one sector the last half of the year. That's great leadership. Now what's joining the party? Technology. Technology was the 5th largest leading sector last out of 11. So it was number 5. It was middle of the pack. But now, when you talk about new highs, what's making new highs? The biggest leaders in the market, those big market cap names. It's not just tech, but it's also financials. JP Morgan, Goldman Sachs. So between financials and technology, that's the leadership we want. And then a new theme, which we saw last July, rotation. We're rotating, not just, we're rotating out of the U.S. into foreign markets. Now we're coming back to the U.S. as the S&P 500 continues to increase and catch up with some of the global indices. But we're seeing rotation. Materials led yesterday. One of materials led. Healthcare caught a bid. It was a beaten down sector. The one sector to watch now over the next 2 weeks, because it moves quickly, is the Russell. So if you want to play the Russell, the IWM ETF is the best way to do it. That usually gains momentum. So people are looking for bargains. They're rotating out of some of those other areas where it was overseas, and they're coming back here and they're parking into big quality names and stocks that have been beaten down.
How much does this mega bill making its way through Congress right now have to do perhaps with some of those gains that we see in the Russell?
That's a great question. I don't know how much it has to do with, but it will be the headline that will fit that narrative. To me, this bill is going to get passed. How and when is the question. What kind of drama and headlines will we see? What divide will this cause between Elon Musk and Donald Trump? It's a soap opera, and you can watch it, have your popcorn, but the market doesn't care. The market was making new highs as this was going on. It matters to Tesla shareholders because that stock's going to be extremely volatile if this, feud grows. But overall, for the market, I think once we get past that, and then July 9th, which is
yes.
tariff deadline day. Yeah. We'll see what happens. I wish it was on a Tuesday. I could have called it Taco Tuesday, but you can't have Taco Tuesday on a Wednesday. It just doesn't make sense.
It is just historic, the V-shaped recovery that we saw, of course. Probably in people's lifetimes, the last one they remember, at least more recently, was COVID. Yep. And then with tariffs in the second quarter, we did see a quick V-shaped recovery as well. So with that July 9th deadline approaching, I know you mentioned less volatility, but how much does actually ride on that if the president does do something with those tariffs?
Yeah, if he doesn't quote unquote chicken out, first of all, that struck a nerve with the president. So he's going to be a little more forceful here. Let's see what the narrative is. Secretary of Treasury has been, the calming presence in the room, and he has said that we may extend deadlines in good faith negotiation style. That's what you're supposed to say, and that's what calms markets down here. But if you come out and you slam your foot like you did on Friday with Canada, and we saw a quick knee-jerk sell-off, and now we're back, Canada's our friend again today, we'll be okay. So I think the narrative may cause intraday volatility, but I think the trend, the path set up for the next part of the year with the right leadership in place, technology, financials, and then IPOs coming back to the market. I know there's another one announced today. I haven't done the deep dive to tell you all about it, but the NYSE is going to be busy. Yeah. You're going to be interviewing a lot of great guests coming into this building. So I'm excited for the second half, despite some of the drama that's going to come out of Washington.
All right, sounds good. Jay Woods, Chief Global Strategist at Freedom Capital Markets, rocking that freedom tie. Jay, thank you.
Yeah, you got it. Happy 4th.
Happy 4th.